David, he says, as you were scrolling, there were sell by warnings that popped up. Okay, so I think what we were looking at here, we were in the market sentiment tool. That's what we've been talking about for a little bit. The first 10, 15 minutes, we talked about and reviewed the market sentiment tool. And then we just reviewed, hey, even though we're showing a light buy, is it okay to do bearish positions? And we compared that against doing bullish positions, David, at the same time frame. We looked at the indicator details, which sort of show what we're looking at here for the fences, the 13 criteria that Ernie found that he felt best predicted a movement or a change in the market from bearish to bullish and bullish to bearish when we reviewed that. So you said, as you're scrolling, there were some sell warnings that popped up. I assume that's for stock. Could you use those warnings to buy, sell options at that point? So what we're talking about here is the broad-based market. This went into a light buy. This is our market sentiment tool, David. And I think these are the ones you were talking about, bullish, bearish, using the 13 broad-based market indicators. So we start to see ones go into 4, 5, or 6. We might see this go to the strong buy recommendation. It's not for an individual stock. It's for the market as a whole. As we mentioned, when we checked the overall sentiment history again, we saw that last very bullish buy here when we were in the middle of March. All right, so we saw the bullish buy strong signals. We're in the middle of March at the peak bottom here at around 38.50 at that time. And the market as a whole moved up. Now, not every stock moved up. You know, some stocks fluctuated. We remember some things that happened in April and May. At some of the banking positions, we saw some of the banking fears happen earlier, of course, in the year, in February and in January. But some of the banking stocks didn't really recover, but other stocks moved up. Rising tide lifts all boats, as they say, as we talked about the cliches and the adages before. And then you started to trigger the sell warnings. And we had that sell warning I wanted to show on 720 with, hey, what if we did bull put credit spreads when we saw that versus the bear call credit spreads, and how those would have performed as the general market SPX started to move down. And now we're seeing, we saw a light buy here recently after we hit another lull down to 4,200, went back up to near 43.80, 43.70 if I'm not mistaken. Then we pulled back, and here we are starting to see that light buy warning again. So this is not for individual stocks, David. This is for the market as a whole. And as I mentioned, we were back on power options. There's various ones you can see using the market sentiment tool for adjusting or placing trades. Does it mean it's a good time to maybe buy calls on SPX, QQQ? Potentially, but again, as I mentioned, I will usually want to see those more strong buy indicators. I want to see more of those bullish buys as opposed to the light buy. Light buy is a good indicator. I'm enticed by it. I'm looking to open some new married puts next week, maybe open some new bull put credit spreads, but I knew that I wanted a little bit stronger signal with everything that's going on in the market, everything that's going on globally, unfortunately, as well. That's going to cause hesitation in different markets. That's going to cause hesitations in market sentiment. And the VIX we're seeing is back up to 2171 now. Again, reference, we talked about those VIX calls, the concept of buying calls on the VIX to hedge a leveraged portion of your portfolio, such as bear calls or bull puts as the market starts to shift. All right, so I think that's what you were talking about, David, when we were seeing those. I apologize, when we were seeing sort of those signals there, the different ones for buy and sell. This is based on the broad market. We don't have a market sentiment for individual stocks. It's just based on broad market indicators, and it's worked pretty well for us as how this. John, a follow-up to your question. I want to get to that real quick while I'm here. There was a presentation we did a year ago, I think it was, and a customer had joined us on the webinars, and he had asked, hey, I'm looking to be actively trading options. What strategies can I use in combination, and what structure should I use to guarantee a 3% per month return? Well, I'd never guarantee anything. You guys know that. You all know that. There's no guarantees in the market. There's just what has worked, what hasn't worked, to stay in the game longer term and not get wiped out by trying to be too aggressive or to follow the next trend, follow the next radical 5-legged options position with a cute little name on it and everything like that. Consistent strategies, hitting singles, maybe taking a little gambit with 2 or 3%. I call it playing the lottery, buying a call or a put with maybe just 1 or 2% of my total portfolio, saying, hey, let's see what this does. Let's see what this new technology does over a 4 or 5 month period. Let me buy a 6-month out call or 6-month out put, for example. So I'm sorry, John, with your question related to the market sentiment, bullish and bearish, I wanted to go here. Let's see, 3%. I'm just going to search for 3%. Let's see if I can find it. Yeah. Strategies for 3% per month. Part 1, move with the market. What was interesting about this presentation, I'm going to stop it if it starts playing automatically, of course. So, and let's just, I got to skip the ad, but let's go down here. I want to see more of the description. What we did in this position, in this presentation, and again, it's called Strategies for 3% Monthly Profit, Part 1, Move with the Market. We talked about different ways that we would expect to maybe achieve this return and the risks of targeting, hey, yes, I want to make 3% per month. That's my goals, but I shouldn't expect it, and I don't want to overtrade. But in here, we went in depth into the discussion we just kind of did. What we did is we said, hey, we started, this was in the first 3 or 4 months. It was shown on September 3rd. So it was the first 8 months of 2022. Y'all remember 2022? Hectic ups, hectic downs, back and forth. Powell speaking. Every time he speaks, the market approves of it. Then when he actually does what he says he was going to do 2 weeks ago, the market just tanks. And then he says, oh, I'm going to have to do this with the interest rates, and the market falls. And then 2 weeks later, he does what he just said, and the market moves back up in reaction to what he did. It was craziness, all of it. The market was down in those first 8 months. It was negative. You looked at just broad-based SPX, QQQ. And what we did is we showed, if you just did that preferred bear call credit spread screen that we showed over those first 7 to 8 months of 2022, you would have been down about 16%. Even following the management techniques that we discuss and we approve of, closing for 50% loss, you would have done 16%. Of course, if you did just bull put credit spreads in the first 8 months of 2022, following our preferred criteria that usually comes out with an 83, 84, 87% success rate in that range, with about an average of 11.8, 11.9% return, you would have been down about 82%, I think it was, something insane. Now, if you went back for those same 8 months in 2022 and did bear call credit spreads when you saw the bearish sell warnings and bull put credit spreads when you saw the market sentiment change to bullish buy, your success rate was that 87, 88% with averaging that 11% return, with one hiccup from a Powell comment in July that spooked investors. It wasn't even Powell's comment. I can't say that. That's not fair. It was a labor report that I think that came out in July where the market hiring was hotter than everyone expected, and everyone realized that meant that Powell was going to have to do another increase following what he was doing and what graphs he was following. And the market just, even when it was a bullish and everything was pointing upwards and everything was looking strong, that came out and everything tanked. But over that 8 month period, moving with the market and the market sentiment tool, adjusting from bearish to bullish, you hit the target that was expected. We're just doing bearish, even though the market was down most of that entire time. For that first 8 months, you were down 16% with the money you would have allocated to it. You did just bull puts. Even with stocks in an uptrend at the time and so forth, you would have been down about 80%, 82%, I believe it was. But if you moved with the market and the market sentiment tool, you would have had a positive win ratio that you were expecting of 83, 84, 85%. And would have had the positive ending outcome return, even with that one hiccup that took out a big portion of the portfolio, as we mentioned. Okay, so that's something you might want to trigger. You might want to view, to go a little bit more in depth into that discussion we had on bearish and bullish and using the market sentiment tool. Strategies for 3% monthly profit, of course, on the Power Options YouTube channel. Okay. So just search for 3%. You'll be able to find that. And then you can also look at part 2 on using conservative income strategies, in the money covered calls, out of the money cash secured puts, common ways that look, and how that performed over time as well.